Hi, I'm Howard Lindzon, a general partner at Social Leverage. And today, I am panicked that I may never see a good deal again. Yes, sir. Welcome.
Well, thank you
Knut.
so much. Appreciate it.
How are you?
I'm splendid. Thank you. How are you?
You are splendid. You are a fake sugar. Well, it's good to be here. It's you and me today.
Very nice.
We've had a couple of these where I'm just catching people up on my life. We had an episode about Wallstrip, correct?
Yes, we did.
We had an episode about Stocktwits.
Yes.
And today, taking a switch, one of the most asked questions week in, week out as a investor and entrepreneur is, Howard, what's your biggest mistake? What's your biggest miss? So I thought it'd be a good time, seeing that it's 2023 and I've been doing this 100 years, to go back a little bit and talk about this. What do you think?
I think that's a splendid idea.
Do you have a biggest investing mistake that comes to the top of your mind? It should generally be something, you know.
Oh, yeah. It was my first trade in E-Trade in 1998. It just flopped completely. And that's why I decided my biggest investment strategy would be to follow Howard.
Well, thank you. Do you remember the company?
No, I blocked it out.
How has following Howard worked out for you?
Pretty damn good.
Well, listen, when you find out today about the things we've missed, you may change your tune. You never asked about these, so I'm going to tell you. So,
all right.
In our industry, the venture industry, there is a legendary firm, Bessemer Venture Partners, and they made famous something called the anti portfolio. How do you say that, Ethan?
Anti.
And Uncle Lou. There's anti and Uncle L. So the anti-portfolio, and they say it's honoring the companies we missed. And they've been in business, I don't know, 100 years, writing checks, investing in companies from seed all the way through late stage. And here's a few that they've missed. Jeremy Levine, one of their best partners of recent 20 years, passed on Airbnb. He thought it was overvalued at a $40 million valuation. Whoopsie. Now, I probably would have passed too at a 40. I forget the year, it was 2010. So that's on their website front and center. Apple, yeah, who would have thought?
Right.
Yeah, Apple.
Wow.
They invested in Pear, the computing company Pear, which hasn't done quite as well. FedEx, I mean, who's going to ship stuff? I mean, my God.
Hardly anyone.
What else? Intuit, Quicken, no one will do taxes online or balance their books. And Coinbase, there's the eBay, the list goes on and on.
Right.
And they're shamelessly, which I think is part of the joy of investing, the irreverence, is that they've created a whole anti-portfolio. And I don't know how to feel about my anti-portfolio because it's not quite as deep. Now, there's ways to look at the anti-portfolio. And one is they got a seat at the table. They were asked to dance, right? Does that make sense?
Yeah.
So there's that side of it, which is you have to be at the plate, you have to have money to invest, and then you have to be asked or bully your way in to invest. I assume their anti-portfolio are things that came to them or things that they looked at and they decided for some other reason to pass. And I think in the spirit of that, a lot of people, especially on the internet, that I know, brag. There's a lot of braggadoring. Do you see that too?
Yes.
Yeah. I've never bragged. I guess that is a form of bragging, but I've never bragged. But the internet, especially in the world that I live in, Twitter, FinTwit, and Stocktwits, people brag. They start podcasts. They joyously share the wins. And I have had some doozy anti-portfolios. And so I thought for other investors that listen in, and there are now a few, to go back in time, and we'll talk about three of them. And I want to set the stage because the markets have changed. So if we were to go back in time to my biggest errors, and I would call them errors of omission versus errors of commission. The last few years, we have seen a lot. I think in hindsight, we will see a lot of investors smack their forehead and say, oh, much like you in 98 with E-Trade in the public markets when the markets were going wild, there are more errors of commission over the last few years than omission. There was this FOMO going on. Interest rates were zero. One of my biggest complaints were, people were doing stupid things. We were all farting around with crypto, a lot of fraud at the end. And what we'll see, especially in the private markets, is people upset about the errors of commission, meaning they wrote checks that they probably just shouldn't have. So unlike the FedExes, there's a lot of, I don't know what you would call companies that will be embarrassing, not from a standpoint of I missed it, but embarrassing, like, I can't believe I wrote a check into that. And I myself have smacked my forehead doing that the last 4 or 5 years with my personal money, less so with our LP money, because of the prices. My first huge errors in seed investing were more about errors of omission. And, in thinking back and doing today's episode, I was trying to think through what was different then. And in 2006, 2007, 2008, 2009, when most of my errors of omission occurred, and my biggest one, I think, that I could have swung at a miss was 2013. All that era, people made fun of investing in startups. Even YouTube at the time, people were like, oh, this will never be, it was cat video. Mm-hmm. We had the great financial crisis. We had the internet boom ending in, the hangover from 2000 to 2006. And then you had 2006 to 2008, you had LinkedIn, Facebook, Twitter, and there was this general mocking of these things. They're never going to make money. They are overvalued. They're a fad. And this is even before the iPhone. But I was down the rabbit hole and fascinated by this because I didn't have the scars of the 1999 internet. Like, I hadn't invested in startups. And also, something that was going on is I was immersed in it myself. I was playing with all these products. So that helps.
Right.
So in 2006, I'd started Wallstrip. We talked to that story. And because of that success, I started seeing deals from very smart people. Mm-hmm. So I would say my first error of omission that cost you and me and Ellen, who's listening, a lot of money was Fred Wilson presented Twitter to me. Have you heard of Twitter?
Yeah, briefly.
Well, now you have because Elon Musk. But back then, it was just a bunch of people farting. And there was no iPhone yet, so Twitter was on a BlackBerry, and it was a desktop-ish product. And so Fred Wilson, because of the success of Wallstrip, and we were friends, he presented me an opportunity to invest $25,000 in the Twitter at a $17 million value. Why are you laughing? Why is the intern Ethan laughing too with me already?
Well, because it's
You
funny.
shouldn't be laughing. This is out of your pocket. So Fred offered me as a favor. Well, he didn't think it was investing. It's not really a favor. He had just called me and said, Howard, I know you like the Twitter. You are funny. You post a lot of pee jokes and whatever you're doing over there on the Twitter. Would you like to invest $25,000? And I said, Fred, as a sophisticated now investor in startups, I said, Fred, what is the price? And Fred said that would be $3 million on $17 million valuation. At the time, I think it was 2008-ish. The world was coming to an end. Twitter was growing. But Wallstrip, I had done the deal at like $60,000 valuation. I don't think, well, obviously I hadn't started Stocktwits yet, but I was starting Stocktwits. Maybe I was starting it, and we had raised it a $600,000 valuation. So maybe, right or wrong, I said, Fred, you're insane. Please don't call me with your harebrained ideas anymore, which he hasn't. And I will take the passeroo on this overvalued idea And I remember thinking to myself, and Fred really is funny about this because he agrees. I said, Fred, I'm trying to understand, this again, 2007, 2008. I couldn't dig up the emails or texts, but I couldn't wrap my head around how Twitter could be a 200 to 400, to make 10 or 20 times my money. I couldn't wrap my head around how, in this pre-network effects, YouTube had just sold for $1.6 billion. So I couldn't wrap my head around how Twitter could be a $200 to $400 million valuation. Forget the $44 billion that Elon Musk feels like he got a deal on 16, 17 years later. So that was an error of omission with my own personal money. I think at a point I would have sold, let's conservatively call it $4 billion. The 25 grand would be between $4 and $6 million. Do we have any cash register stands play there?
Ka-ching!
So anyways, Ethan and Knut,
Yes.
that's a big miss. And that is an error of omission. Now, let's give some context to that era.
And did Fred invest?
Yeah, Fred led the round.
Oh, fudge.
And that's why Fred is probably a billionaire and I'm a thousandaire. But at the same time, not only did Fred invest, he said, okay, I understand. I explained to him why I was passing. And his next call was to, I think it was the next call, because he still was going to let a friend invest $25,000. His next call was to Jeff Pulver, who, of course, invested. And Jeff is now retired. And every time for the next few years, Jeff saw me in an event, he would run up and hug me. So I thought that was funny. Jeff would just say thanks for turning down that investment. So there was it was a bit of a funny thing. Now,
did he offer to share with you his winnings?
No. He didn't. He would just dance in front of me. And,
it wasn't a victory dance.
point.
It was a happy dance.
He would dance and point to me.
Oh, my God.
So what did we learn from that? Because it's important. That was the beginning of my investing in startup career. And I couldn't understand. Remember, this pre-AWS, this pre-iPhone, pre-mobile explosion. BlackBerry was just texting. It wasn't the full internet. So in my mind, I don't think like Fred, that network effects was just not a term that was famous. And so couldn't get my head around, even though I was using the product, couldn't get my head around how that could be 10 to 20 times my money, how wrong I was. And this was just my personal money. I didn't have a fund at the time. So I remember Fred telling me a few things over the years, because we joke about this all the time, is if you love the product and you love the team, didn't know the team, and you think the TAM, the total addressable market, is big, you can't worry about the price. And that was, a lesson that Fred, in hindsight, explained to me. And again, even to this day, I don't know if I can get my head around that concept. And to be honest, over the last few years, that has helped me avoid errors of commission, because I feel like the crypto craze and the end of Web 2 led a lot of people for 15 years of seeing these Twitters happen and Ubers and Airbnbs, that people just felt, okay, this is going to be huge. And they compared themselves to the Twitters and Ubers and Airbnbs. And they made these investments not really understanding that network effects was ending, and that without network effects and without 0% interest rates, you can't just take a pithy comment from Fred and apply it to every type of investment.
So true.
So it was a great lesson for me. And my takeaway was, I'm at the plate, I'm using these products, I believe in this trend, but I missed it. The next big miss was almost right after. It was Mark Pincus at Zynga. We had invested together in a company called Buddy Media. Mark had an idea at the first board meeting while we were in the bathroom to start a company called Zynga, named after his dog. And we had kind of agreed on a price. At the time, we had invested in Buddy Media. It was $1 million on 2. It was a 33% dilution for the founder. 1 on 2, which is absurd in today's market. But, well, not absurd, but founders will not do 1 on 2 deals because they've been getting 1 on 20 and 1 on 15. Mm-hmm. But in that era, we struck up a deal, in the bathroom, Mark and I, and we agreed to do the same terms, or we had talked about the same terms as Buddy Media. Flash forward a few months, and Fred emails me or calls me, and he says, we're going to lead the Zynga round. And I said, yeah. And Fred says, Mark told me that you were going to invest, so I'm calling you. We're closing the round. And I said, great. What are the terms? Thinking that, Fred would say 1 on 2. And they were the same as Twitter. They were 3 on 17. And so in my head, I was already up 8 times my money. But I wasn't. Those terms were long gone. And by the time Mark did get around to raising money, it was at 3 on 17. And it was right around the same time. Mark wanted to build a poker app. He had a successful poker app on Facebook. And he was going to build, Zynga games. And my genius, I was upset at the change in valuation and the same mistake because I didn't understand network effects. Facebook was new and I'm not a gamer. I passed on that round. And I think that 25 grand would be worth about 10 million. So there's 14 million just scratched off the balance sheet of Lindzon Enterprises. And so those are 2 massive personal errors of omission where I saw them. I knew the people. I loved the product. But because of the macro and because of where we were in time and because there was no FOMO, there was the opposite of FOMO. There was skepticism about network effects. There was skepticism about YouTube, Twitter, Facebook, LinkedIn. There was no mobile phone. It was hard for me to project these valuations into being something that we could make money. Does that make sense to you, Knut?
It does make sense.
So I can sleep at night because if I were presented with these ideas today, I might make a more informed decision. But for me, that when valuation makes no sense to me and I'm holding something what I think is going to take 7 to 10 years, I really need to understand why I'm locking up my money. Now, you flash forward to 2023, interest rates are 5% and on the way up. We have a throttling of network effects, meaning Apple is throttling through privacy, Facebook, and therefore network effects are dying. Elon Musk has shut down the API on Twitter. Everybody has an algo, and everybody's shutting their pipes versus 2006 to 2010. They're opening their pipes. So now I'll talk about my biggest miss, because first of all, price wasn't a problem. Second of all, I had unbelievable confidence in this trend. And thirdly, it was right there to write the check. So this was in 2013. Company at the time was called eShares, and today it's called Carta.
Oh,
I don't
yeah.
know. Do you use Carta?
Yeah.
So Carta is where you get all your updates about our fund, etc. So at the time it was called eShares, and the founder, Henry Ward, was raising money on AngelList. And AngelList is a platform that allows founders and investors to meet, kind of like Facebook of investing. And I am an investor in AngelList, proud investor in 2010. And so we, at the time, 2013, AngelList was kind of a place where people just hung out and shared deals.
Right.
And I had this really, I had probably my best ideas was wrapped around one thesis, which started in around 2006 when I met Fred Wilson. And one of my beefs about venture capital at the time was because I was coming at venture capital from a hedge fund world in a wealth management and money management role. The venture capitalists of that era, especially the best ones like Union Square, they would give money to people like Jack Dorsey, people like Mark Pincus, at the highest risk moments of the business. So they would invest, let's say on Twitter, Fred would invest, the firm would invest 3 on 17. And then if that company worked, as it did with Twitter and it did with Mark Pincus, and those founders would make $1 billion, they would then get a cold call from Goldman Sachs, or Goldman Sachs would court these people. And that money that they made would go to Goldman Sachs, meaning, yes, the founder makes money. Yes, the venture capital gets 2 and 20, but the $1 billion that the founder made would now go on deposit at Goldman Sachs. And Goldman Sachs would then go on to rape and pillage clients to the tune of, 1% a year and $1 billion. That math starts adding up. Does it not, Knut?
Yes, it does.
So I remember calling Fred. I go, Fred, you don't know what you're doing here. You've built all this trust. Union Square takes such big risk on these teams. And then when the company works, the founder takes his cash away from Union Square, gives it to a bank. And the next time you speak to that founder is when they need high-risk money again. I said, wouldn't it make sense that you would offer these services in and around Union Square? Wealth management, a family office setup. Shouldn't Union Square do this? And I remember Fred saying to me, maybe, but we don't want to be in that business. And so from that moment on, I understand why Union Square didn't want to do it, but I said, no, that's coming. There is going to be banks and firms that see this problem, and all these things will be connected. If you are a seed investor and very good, you'd be silly not to offer all these services at somehow so that you could stay connected to that capital. So that was a thesis of mine from the time Fred, passed on the idea, because I said, Fred, let me set this up for you. I mean, it's silly to leave all this capital on the table. You hire a few good people to run these family offices services at Union Square. You can keep the circle of life going within Union Square. To his credit, Fred said, it's a good idea. It's just not for us. Flash forward to 2013, and I'm an investor in AngelList. I started Stocktwits. You've got Wealthfront, you've got Betterment, and you have all these financial apps. There's no Robinhood yet, but you have all these financial apps built around wealth management and managing your money and, trying to copy Vanguard. And along comes this idea, eShares, and the idea is just basically for founders to organize their cap table online. And this is something that before this had been tried many times. But really what happened was a very paper-oriented business where the lawyers would mark up the cap table. It was kind of controlled by the lawyers. And the lawyers would really be able to charge a lot of fees, if you remember in the days. And you'd send a cap table back and you had to eyeball it. And it was all very much done mechanically on an Excel spreadsheet, but controlled by the lawyers. So Henry Ward's idea at eShares was to get all this automated. And I thought it was really genius. And we were excited about doing the deal. And at the time, our fund would write $100,000 checks. So this would have been something you could have invested in,
right,
if we had followed through on this. And the valuation of Carta was somewhere around $4 or $5 million. There was no checks against it. The price seemed reasonable. And this is 2013. This is, $5 million wasn't extraordinarily high. The founder had a great idea. It was a product that I definitely thought should be built. And we had long conversations, email threads and conversations with Henry about investing. And we would have been one of a couple $1 million check or $1 million check. So it wasn't like the deal was not decided on whether we would write the check. We just had an opportunity to invest $100,000. And it wasn't for lack of trying by Henry. Henry followed up and really wanted us to invest because it was a thesis of mine. And I remember calling Naval. This is our mistake. This is where the mistake started happening. This is where Social Leverage should have just written the check. And this fund was also the fund that invested in Robinhood. So Carta, this is why it hurts me, is that it's not that we didn't see it. Our job is to make sure we have a thesis. And this is why I think Bessemer has their anti-portfolio. They can't explain why, they just pass. So we had done the work. We were at the plate. We saw the deal. There was no problem with the price. Henry was chasing us down. Tom liked it. Chris Corvo liked it. We knew it was not a huge technological moat, and it was not going to be easy. So I remember calling Naval because Naval who founded AngelList, and Naval and I had many discussions about what I had talked to Fred about over the years and how AngelList could be that hub to control all, the life cycle of founders and cap tables. And because eShares was shared to me on the AngelList platform, I assumed Naval knew about it. And I called Naval and I said, Naval, I mean, are you going to let Henry and eShares exist? Shouldn't this just be a feature of AngelList? You know, this was part of my plan for investing in AngelList, that AngelList was going to run the table here.
Mm-hmm.
And I don't know exactly what Naval said to me, but he did agree that this was something that AngelList should and would build. And therefore, my mistake was probably over due diligencing and making that call to Naval. Really, I should have just written the check and let the competition, go, Knut.
Bet on both horses.
Bet on both horses, or just, you weren't betting on both horses. Naval liked the idea. He didn't commit to doing it. It was just sitting there in my lap. And because I assumed that Naval, from my conversations, was going to build it, and because they would have network effects, which by now I knew what network effects were, I thought that Carta really didn't have much of a chance. Or if they did, man, it was going to be a fight. And today I think Carta is right around $6 billion. So, $100,000. And that fund was a $6 million fund, and it had Robinhood in it. So assuming we wrote no more checks and that we held to about a $2 or $3 billion valuation, that's about $30 million, Knut.
Okay.
So,
so
that is what you call. Have you had something that big? Was your E-Trade miss that big?
No, not even.
So there is a story. I think if you are an investor, hopefully this helps you take away a few things. There's no specific way to prevent the anti-portfolio. There is two things. One is make sure that you're seeing things. The good news is we were seeing things. We had an opinion, but that was one where we didn't swing. We just completely missed. I can't explain it. Henry's still the CEO. The company's gone on to change its name from eShares to Carta. Fred Wilson and his firm ended up investing at the next round. So I remember biking in Coronado and getting a call from Fred, pulling over, and he was saying, we're going to lead. And I was just like that sinking feeling where, a year and a half later, they're doing the round, and it's like the legends are doing the deal, and you had passed on it pre-legend.
Oh.
Yeah. So that is one that stings. And I think if you've been in the business or writing checks, you will have these. And I don't know if it's worse, errors of commission or errors of omission. But I thought I would share those in the spirit of, honoring the companies we miss. So that's Twitter, Zynga, and Carta. This is where, the Seinfeld episode, Even Steven, when you write checks over this many years, 20 years, sometimes you get lucky, and I call it Even Steven, where something that shouldn't have worked out so well works out really well.
Yep.
So if you are going to invest, remember it's, 20, 30, 40-year life cycle of investing. You are going to be doing this a long time. There are going to be errors of omission and commission. And, really think through your anti-portfolios and go through that and embrace, that you are going to miss things. So hopefully that helps, Knut.
Yeah, and I'm really depressed.
So you figure on a $6 million fund, probably another 5 times, conservatively, your money. So it was expensive.
Yeah.
It was expensive, and that is part of investing. For Henry, I used to write about it all the time in 2015, 16, 17, not knowing it could get to $6 billion, and he was always a good sport about it. I did try and get me in that company. I think I would have been a good investor for that company. We use the product.
I know.
Now, today, 2023, AngelList does have a strong competing product. I think there's a few products out there competing. But what did I get wrong? Well, AngelList was slow. They were busy building their fast-growing business and never got around to adding this feature, which might have sidetracked them. And Carta just ran like hell. eShares Carta just ran like hell. And honestly, the product today is pretty much what the product was back in 2013, other than the name change. So kudos to eShares Carta people. Kudos to Pincus and Zynga. Kudos to Ev and Jack at Twitter and Union Square. But that is my anti-portfolio. Any thoughts, comments, Knut?
I just remember we had an opportunity to do more shares in LifeLock after the fact. And I think we were a couple of cents off, and I'm like, oh man, I want some more of this stuff. And they did great.
Yes. So LifeLock was one that we did a long time ago as well.
Yes.
But we won there. We didn't win as much as we could have.
We did win.
Yeah. So if you do this, give yourself a little bit of a break. Keep track of the ante portfolio. And hopefully this helps people. You are listening to Panic with Friends. Today was a special episode where I beat myself up. But generally we have entrepreneurs, founders, venture capitalists, traders, trying to keep people, one step ahead of the curve. You can search my name, Howard Lindzon, or Panic with Friends on Spotify, Apple, Google, the internet. And you will get a link to Spotify, Apple, Google. You can subscribe, and you will get one of our shows every Thursday. It hits, and you won't have to do anything else but lean back and listen. Knut, thanks for doing this. We will see everybody next week.
Howard Lindzon is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or Stocktwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.